Hello, everyone. Welcome to today's edition of The Final Bar. We're going to talk to Bogomazov from Wyckoff Analytics here in a few moments. Talk about cryptocurrencies. Certainly have been on the move, showing some renewed signs of strength. Speaking of strength, the S&P 500 pushing to the upside as well, led by the NASDAQ. It's technology number one, sort of a rare look for this market. Tech shares have been struggling a bit on a relative basis, renewing to push to the upside with semiconductors, especially NVIDIA, up pretty big. Ladies and gentlemen, this is The Final Bar. Everyone, welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of technical analysis, using StockCharts.com to better understand market dynamics and quantify investor behavior. We've talked a lot in recent weeks and in recent months about sort of this bear market phase and bear market rallies, what they look like, what they feel like, the suddenness, the severity. We are testing the upper bounds of where I feel comfortable calling this a bear market rally, and I'll show with you some of the charts that I think are crucial in making that rotation. You know, to be honest with you, I think as this market has been choppy, as I've talked to a lot of my guests about the choppy, uncertain environment and how to think about it, you know, thinking more longer term certainly, has a lot of value, but it's also recognizing that a lot of individual stocks are looking pretty good. While the S&P, the NASDAQ, we can debate whether they're in an uptrend or a downtrend. There are certain charts that are so obviously in a consistent uptrend. I think it's undeniable, and I would encourage you to focus on the reality, the evidence based on some of those individual stocks. Regardless of what the major averages do, there are individual names most likely going up and going down. We just have to find ways to identify those and follow the appropriate trends. We have a great guest today, Bogomazov. It's always a pleasure to have him join the show and talk about Wyckoff analysis. Next week, three good guests lined up for you as well. On Tuesday, the 29th, we have David Auerbach from the Daily REIT Beat. On Wednesday, the 30th, Mark Newton, who's a managing director at Fundstrat Global Advisors in New York. On Thursday, the 31st, Tim Tashler from Sprott Global. He's an expert in commodities, gold in particular. So we'll talk about the renewed strength in precious metals. Also, earlier today, our 2022 Chart Madness special just aired. You can access it on demand at StockChartsTV.com. If you go to StockCharts.com/ChartMadness, you can download the bracket that we used in this special. Four of us took a bracket of 16 stocks, debated the strengths and weaknesses, came up with our final four, and then our champions, our projected champions for the next 3 to 6 months. So you can get the view on demand at StockChartsTV.com. Let's continue on with our next segment, the market recap. Let's focus on what happened today and think about how that relates to the big picture. The S&P 500 certainly showing some renewed signs of strength. You know, 2 days ago on Tuesday, we closed above the 200-day moving average for the first time in a couple months. Yesterday was a bit of a give back and some weakness going into the close. It's one of the weaker days we've seen in the last week and a half, to be honest with you. Pretty rare in a period of short-term strength. Today, sort of resuming that uptrend. Yesterday was a bit of a pause, and today continuing the push higher. S&P finishing the day around 4520. That's up 1.4% from yesterday. The NASDAQ 100 up 2.2%, with technology the number one S&P sector. So while there is strength in plenty of places in this market, technology, again, coming off in general fairly beaten down levels, but the NASDAQ, continuing to push to the upside. The VIX back lower, below 22 today, nearing that 20 level. We talked about being above or below 20 at times has been an interesting indicator of a more volatile or less volatile environment. We're pretty close to VIX 20 from above. Interest rates overall finished today a little bit higher, although the big move was around the open. After that, settled down a little bit lower, closing the day, the 10-year yield around 234. And again, we've had a rise in rates and certainly expectations that make sense to me speak of higher rates going forward. You had one of the Fed governors this morning talking about the short end of the curve going up to 2.75, 3%, I think, which would suggest the entire yield curve continuing to elevate. The dollar index essentially flat. The UUP, not a lot of movement from where we were in yesterday's show. Gold and silver both moving to the upside. So while commodities came off overall and oil prices, energy prices were lower, precious metals, gold and silver were up. So again, this is a great reminder that gold is not on its own just a safe haven moving inversely to stocks. A lot of different things, a lot of different competing narratives on here. We've seen gold, and particularly gold stocks, really start to accelerate to the upside, really emerge from pretty broad bases, and that arguably probably about an inflation hedge more than anything here. Cryptocurrencies, for the most part, higher. 9 out of the 10 of the most common coins that we track on StockCharts.com in the green. Both Bitcoin and Ethereum prices up over 2% from where we were yesterday at the close, and Ethereum above 3,000. Yesterday we closed above 3,000, and today continuing that push higher around 3,100. Bitcoin as well nearing 44,000. Actually traded above 44,000 a little bit earlier today. So both of those managing to chip away at some previous levels of resistance and potentially following through to the upside. Let's look at a chart of the S&P 500 here and take a look at what's happening from a short-term to long-term perspective. So my market trend model, which I don't update until Friday after the close, but if you look at where it was last Friday, it was telling me long-term trend positive, which I would agree with. It was telling me medium-term trend negative, which I would agree with. It was telling me short-term trend positive. So it makes sense on all three timeframes. I think that's about right. The kicker is, at what point does the medium-term trend, which for me is sort of a couple months, to a year or so, at what point does that turn more positive? And I would argue we're getting really close to where it's feeling uncomfortable calling this a bear market rally. I've been pretty vocal about the fact that bear market rallies can be sudden and severe, and in general they're against the larger trend. But how can you tell when a short-term trend is materializing into something longer term? A couple things that I've learned to pay attention to. Number one is momentum. Do you see enough improvement in price momentum that it tells you the conditions are shifting? Number two, do we break any key trend lines? Can we take trend lines from the highs, and have we broken them? Number three, do we clip some key levels of resistance? Let's look at each of those 1 through 3 very quickly. When I'm looking at the RSI, a measure of momentum, that was my first point. Number one, you saw the RSI break above a trend line, taking the high from November, December, connecting those. We've broken above that. What's interesting right now is the RSI is right at 60. Chart of Apple, the RSI is right at 60 as well, I believe. And what that tells you, what I have found is in a bear market phase, the entire range of RSI comes down. Something Connie Brown's book taught me early on in my technical analysis career. In a bull market phase, the entire range will go higher, and you'll see the RSI rarely get below 40. So when the RSI is unable to get above 60, that usually tells you that in general, you're in more of a bearish phase because there's not enough upside momentum to really provide a sustained move to the upside to change that downtrend. We're right at that point where you could start to say that we've eclipsed 60, that the RSI is breaking out and showing enough upside momentum that there may be some staying power here. So it's right at that decision point. Same with Apple as well. Number two, we talked about breaking through any trend lines. If we take a trend line from the January high and the February high, we broke through that about a week ago, actually. Going into last weekend, certainly coming out of it, we saw this week, we've seen renewed strength with the S&P breaking above that trend line, and so far really not looking back from that. So a trend line using the highs has been broken, and that's number two. Third piece would be, can we eclipse some key levels of resistance? I would argue getting above 4,400 was important because that was the most recent swing high, but that's pretty short term. Longer term, you want to do things like get above the 200-day moving average, which we apparently have done. We did it on Tuesday, closed below it yesterday, but now back above it. As long as we hold that 200-day and remain above it, I would say overall this is a constructive pattern. Getting above some of these previous levels of resistance, I would say 4,600 would be a really key level. That was the high from February. Once we do that, I don't think you could legitimately call this a bear market rally anymore. I think you have to label it appropriately, which is more of an uptrend where a corrective pattern has completed, and now we're seeing enough upside strength. My medium-term trend model, as I mentioned, was negative as of Friday. Last week, we'll see Friday's close this week if we get any change there. Going back to our dashboard, just to wrap up our market recap, let's look at some of the sector themes that we saw today. When we're looking at the 11 S&P sectors, we have tech finishing the day up 2.6%, followed by materials. When I was screening for new swing highs earlier today, I saw a number of things in the materials sector, and it's names I mean, we've talked about often, like Mosaic and others, but a number of material stocks starting to break above resistance. It's a sector with a lot of breakouts in there. It's not just one or two names. Communication services number three. So you have some of the more growthy parts of the market up at the top here, and there's enough market cap there with them. When those sectors are moving as high as they are, most likely the S&P, the Nasdaq are going to be up pretty significantly as well. What underperformed today? Well, energy is continuing to fulfill what we talked about, which is it's either number one or number 11. It's either at the very top or the very bottom on any given day, because it's obviously a key story year to date is the continued strength in energy. Still up today, but up much less than the major averages. After that, it was consumer staples and it's real estate. Both of those are fairly defensive sectors. These tend to be a little lower volatility, a little higher dividend, a little more conservative, a little more defensive plays. So it was really in general, I mean, generally speaking, you have kind of offense over defense. And with energy, which has obviously been one of the best performers year to date, the worst sector today. Wanted to just finish off our market recap looking at NVIDIA. So you have a lot of the chip makers that are doing pretty well today, the semiconductor stocks, that is, and NVIDIA is a great example of that, up almost 10% today on news related to Apple. But if you think about what we just talked about with the S&P 500, what would convince you that the chart of the S&P, or convince me that the chart of the S&P was changing? We break a trend line, the momentum gets more positive, and we break resistance. I would say today all three of those things have now happened. NVIDIA has now broken above a trend line using its previous highs going back to November. The RSI is now above 60, which tells you there's enough upside momentum. And now we've gone above 260, 270, which was the resistance level from February. This is a chart, one of the leading names, one of the biggest names in the U.S., breaking out to the upside. Folks, we need to take a quick commercial break. We'll be back with today's guest, Roman Bogomazov. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down these markets using the technical analysis toolkit. A couple quick comments before we get to today's guest, Roman Bogomazov. First off, we welcome your questions. Tomorrow on Friday's show, we'll do another mailbag segment. We'd love to feature one of your questions on the air. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, via Twitter @FinalBarSCTV, via YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We had a great time recording Chart Madness, just aired earlier today. Our latest episodes of The Pitch, featuring top stock pickers sharing their latest ideas. All sorts of fantastic guests like Roman Bogomazov and many others for free on demand from StockChartsTV.com, or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Roman Bogomazov. Roman's the founder of Wyckoff Analytics, coming to us from San Francisco. Roman, good to see you. Welcome back to the show.
Good to see you, David, as always, and really happy, to be on this segments.
It's good to see you. We're looking at your chart of Bitcoin. Obviously, cryptocurrencies have had a choppy phase, but we talked earlier in the market recap, Bitcoin, Ether moving to the upside yet again today. Talk us through your chart of Bitcoin. What are you seeing?
Well, first of all, let's look at the downtrend that we've been in since the late October, and it has been broken. And since the low of that downtrend in January, we see a change of behavior rally going into the mid of February or about, and then the whole structure goes into the apex or the triangle formation, during which all of the attempts to go down are failing. We're having local sprints, we're having the tests. And please note how the supply signature, those red volume bars, are starting to diminish, and specifically into the last reaction that we have in the middle of the trading range. This is where we see that supply has been exhausted, sellers are exhausted, and that is very suggestive of the continuation to the upside, which is very unusual. And the whole sentiment on the social media right now for the Bitcoin is still to go down. When we see that type of sentiment in the very, very oversold condition, that usually indicates a contrarian potentially move. I also want to point your attention to the last rally. The rally duration is extremely important because it's an element of control, And we're seeing that in the last rally, as of today, we've been in that rally for 11 days, whereas the previous February rally, we've been in that rally for 8 days. So what does it tell us? Buyers are in control, and little by little, climbing the wall of worry, we're going up. And that's not just reflective on Bitcoin or Ethereum, the big caps in the crypto space, but also the crypto space itself. And as you could see, we are seeing right now, for those of you who are in the crypto market, some rotation that we're seeing money going into smaller and medium caps. You still have to be extremely selective in that space, but our overall opinion of the cryptos is that this is an opportunity place where we should take our bets. We should start selectively creating and adding to our portfolios. And I just want to chip in a little bit, David, if you don't mind, my quick outlook on the market as well. The current rally that we're seeing in the Wyckoff terms, we're interpreting as a change of behavior to the bearish environment that we've been in since December, January. So for that to be confirmed, we just need to have one reaction that will change the character as well, will be less bearish than the previous reactions. And that would confirm the change of character and potentially confirm a change of bias.
And sorry, with that last point, are you talking about the S&P 500 there, the broader equity
S&P
markets?
500, yes.
Can we look
the
at that
stock
chart
market.
together? I'd love for you to share again, just while we're
Absolutely.
looking at it here. So, what we talked about is obviously a lot of individual names peaked in November. The S&P moved a little bit higher, made a new high going into year end. From there, rotating lower and now jumping in the last week or two. And then again, can you just describe what's your take now, given what we've seen with the short-term strength here?
Well, first of all, I just want to reiterate your comment about being selective right now. There are a lot of charts that look so great. There are a lot of charts in the uptrends. There are a lot of charts that are rallying off the oversold conditions, and they kind of at the point of the conclusion of the reaccumulations. But you still have to be extremely selective. This rally is the best rally in the trading range. The last reaction as a test to the spring, which occurred on the 24th of February, is also acting as a sign of strength. So we're still considering this formation as a trading range with the bias to be determined, to be confirmed. But the current rally that has the increase of momentum, that has kind of like an ability to extend, and the most surprising thing to me in the stock market is actually NASDAQ, the tech stocks, because they were not very favorite in this interest rate environment. And yet we're seeing probably out of the oversold condition, some value that institutions are picking up, and that moves the Nasdaq higher.
It's interesting when you're looking at the Nasdaq. The Nasdaq composite is what we're looking at here. That level around 14,000 ended up being, it was a little above there, but much of 2021 we sort of bumped up against there. We then bounced off of there a number of times, and so now we've rallied up right into that same level. So using your toolkit, what would you need to see from the chart of the Nasdaq to confirm maybe a new bullish phase, and this is the time to get all in? Is there a particular level or signal or confirmation that you would need to see to feel more be more, I guess, supportive of what's happening with the price?
I would be looking for two things. First of all, I just want to say that this blue dotted line that you have, we would call in Wyckoff methodology an axis line. So this is where the price deviates below and above. So it's very clearly defined, and you're showing it so well here with so many points of resistance and so many points of support. Two things that we want to see. We want this rally to extend as much as possible, preferably to 15,000 on NASDAQ. And the second thing that we want to do is to observe the character of the next reaction. Would it create a higher low? Would it have an increased supply signature or decreasing supply signature? Would the downward spread as the measure of momentum decrease or increase? And that will give us a really good indication as a confirmation of what this rally that we are currently in is all about.
Roman, this is awesome. This is a mini masterclass in how to think about some of these big picture moves in uncertain times. So thank you for having a fantastic perspective and sharing it with us today. Stay safe down there in California. We'll talk to you again soon.
Thank you so much.
That's Roman Bogomazov. Roman's the founder of Wyckoff Analytics and does such a great job of explaining what has been a fantastic methodology. Our mutual friend and Roman had a chance to work with Hank Pruden much more than I was able to do, but he was really one of just the most fantastic human beings I had met in the industry. Fortunately, no longer with us, but I know talking with Roman, talking with Bruce Frazier, you see little hints of Hank's work, and I think that's a great tribute to the legacy of a fantastic educator and strategist. So great take there from Roman Bogomazov. Let's continue on today's show with our next segment called Getting Sentimental. What we love to do is look at some of the market sentiment indicators. A lot of these are updated Wednesday into Thursday, particularly some of the survey data. So Thursday shows a really good time to just check on where we're at. I tend to look at these in three different pieces. We'll start with volatility, we'll look at some surveys, and then we'll finish off with put-call ratios and see what messages we can break down from each of those areas. We'll start with the VIX. The VIX, as you may or may not know, is looking at volatility, the options market on a major index. It's from the CBOE and essentially implying the volatility on the underlying indexes. So you sort of infer the volatility of the S&P by looking at the volatility in the options market. And what we can see is the VIX had hit 30 a number of times. And one of my comments to anyone listening here when we broke above 30 so far is the fact that in November, that was actually a buyable dip when we got to 30 in late January. That was when we broke above 30, decent time to buy. And then in early March, we had the same sort of pattern. Now, again, we got above 30 and then accelerated even further. But that first move was back here when we hit almost down to 4,100. So we've seen just recently that the VIX has gotten above 30. That's been an interesting or a pretty good indication that a short-term bottom has formed. The problem with, and I would love to tell you that that's how easy it is. Just watch the VIX going above 30, and that's all you need to do. The problem is volatility regimes are pretty fluid, right? So if you look, 30 and 15 to 20 is an interesting range in the last 6 months. But if you go to the middle of 2021, the entire range was different. It was really more between 15 on the lower end and 20 to 25 on the upper end. Back in late 2020, early 21, the whole range was higher. 20 was the lowest level we got. We got up to 35 or 40. So the problem that I've seen with using the VIX as a trading tool necessarily is the fact that unless you have perfect foresight and you know when the VIX is going to turn, which I tell you is very hard to do, it's hard to anticipate turning points using the VIX. However, I found it's really helpful to just see where we're at relative to where we've been, and particularly if you think about a current market phase. So, for example, I think we've been in a bearish overall phase since November, and again, we're getting close to where I'd stop calling this a bear market rally, but I don't think we're there yet. This is why I think this is the change in volatility. The volatility was lower before that peak in November on a lot of individual stocks. Now the volatility has increased. Getting down to 20 is actually where we peaked out the last time the S&P hit 4,600. That was the short-term rally into resistance before we made the next leg lower and got below 4,200. So an interesting pattern to watch for. The VIX getting back down to 20, which is really toward the lower end of the range that we've been in over the last 6 months as price reaches former resistance. Next chart, looking at sentiment data. This is the AAII survey. One of my favorite parts about this data set is that there's just so much history on it. You know, is it an ideal survey of thousands and thousands, millions of market practitioners? No, it's a small subset of individual investors. However, the fact that it's been so consistently run is that you can look back at major tops and bottoms and understand how the survey data relates now to where it was in some of those previous market cycles. What I'm seeing right now this week is from last week, we were just above 20% bulls. We've gained about 10% to the bullish reading this week, just below 33%. The bears have gone from about 45% down to about 35%. So you had a huge swing from bears to bulls, essentially. And it also, we don't show the neutral rating, but it could be bears to neutral and neutral to bullish. I don't really know exactly how they switch, but in general, a much more of a bullish reading. This is the highest bullish reading we've had in the AAII survey since the end of 2021, which is that market top there in December going into early January. The spread between the two is the narrowest it's been since January as well. So we've had very much a bearish bias to this environment for quite some time. Now, what's interesting is And this is one of my favorite things about this chart. Look back at 2020, right? We had the sell-off February, March of 2020. You saw how bears were far outnumbering bulls. That's why the spread between these two is so negative. It took about 8 months for that indicator to get back to net bullish, right? And that's as the S&P was rallying significantly from the low around 2,200 to when it finally turned positive. The S&P's up here around 3,400, 3,500, right? It really didn't turn net bullish until we broke out of that congestion range in the fall of 2020. So it was about a 6 to 8 month period where it was still overwhelmingly bearish sentiment, even though the market was rallied. When I talk to people like Bogomazov, who studies Wyckoff analysis, which is really a framework, what he would call a schematic to describe price behavior and what it implies about investor behavior. Or if you talk to someone who's an Elliott wave strategist who's talking about wave counts and what a wave one most likely looks like. In general, that's sort of the smart money, the early adopters buying in to severe price weakness. The masses are not buying it yet. They come in a little bit later in that big long wave three. This plays out beautifully with that general thesis of how the beginning of a bull market phase actually starts. Might be worth watching now if you continue to see negative or net bearish sentiment as the S&P pushes higher. But for what it's worth, we've alleviated that severe bearish reading, almost an even push between bulls and bears at this moment. Just very quickly to wrap up the segment, the name exposure index increasing a little bit, but still not that high. The lowest we got to was just below 30%. We've not been that low very often. Actually, you have to go back to first quarter of 2020, fourth quarter of 2018, and then back to 2016, 2015 when we got that low. We're jumping up in the last couple weeks as money managers are buying into this rally a little bit, but still nowhere near a bullish configuration based on that data. That's our segment, Getting Sentimental, where we focus on some of the market sentiment readings. Let's finish up today's show. Go to the 3 in 3. 3 charts in 3 minutes, some of the top ideas of the day. Here we go. Chart number 1 is the daily chart of the S&P 500. I'm so glad that I was able to ask Ramon a little bit about the S&P. We talked about the NASDAQ as well. And again, I will always be honest with you on the show, and I'll tell you it is getting harder and harder to describe this as a bear market rally. What Ramon was talking about on the chart of the NASDAQ was essentially getting above the February highs. And that's what I mentioned as well. We get above 4,600, I think it would be virtually impossible to label this a bear market rally anymore. You have to describe it as something more impulsive, meaning in the direction of the larger trend. I think that's when you have to start talking about a market recovery, the likelihood of regaining all-time highs, if not further, S&P 5,000 plus. But first things first, we have to get above that resistance level, and the RSI has to get above 60. You're finding it on some individual names like NVIDIA on a big move today, but not on everything yet, and that's what I'll be looking for. Chart number 2 is the AAII survey, again, the American Association of Individual Investors. We're almost even right now between bulls and bears. You can see during different phases in the last couple of years, you can see times when the net sentiment has been very constructive, when the net sentiment has been very destructive or very net bearish. We're coming off a fairly bearish rating, and if you look back, when the sentiment is this bearish, it's usually pretty rare that you get that big of a spread, 30% spread between bulls and bears. It's pretty rare when you get over 50% bears. The kicker is 2 things. Number 1, having bombed out sentiment like this often happens during a corrective phase right before there's a rally and a move higher. That's super encouraging. If you take this chart, which is part of my morning coffee routine chart pack, which you can access on your chart lists on your dashboard on StockCharts, go back to 2008 and 2009, you'll find that the bears went below 50% and remain there for quite some time. That's the reason why I can't just say we got down to 50%, it's a raging buy, because extended bear market phase will start to look like that at the beginning as well. Finally, consumer discretionary versus consumer staples, offense over defense, testing resistance on a cap-weighted basis, but not on an equal-weighted basis. So you have big moves in Tesla, Amazon, Home Depot, any combination of those. This ratio is going to tip higher very quickly because of the huge cap on that side, the numerator of that ratio. But on the downside, you can see, or on the bottom panel, you can see that on an equal weighted basis, we haven't gotten above there. I would want to see that get above resistance on an equal weighted basis to feel more confident about a market upside from here. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Ramon Bogomazov joining us from San Francisco at Wyckoff Analytics. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.